Welcome back to Investing Talk Podcast.
Today we're looking at Oklo.
The Advanced Nuclear Technology Company. This is a fascinating one, a really high-stakes profile that I think demands we look closely at the immediate financial volatility versus its monumental potential in the energy market.
It absolutely does. It represents the cutting edge of, industrial electrification and that massive power demand being created by AI.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For any company that exists purely on future promise, the financials are, they're often the immediate bear case, and that's really where we have to start here. The Q3 2025 results, for example, delivered a pretty significant negative surprise to the market.
That's right. When you look at the fundamentals, they reported a loss per share of negative 20 cents. Now, that missed the consensus forecast of negative 13 cents by a pretty wide margin.
And in this world of high expectation, pre-revenue companies, missing that kind of low bar, it causes serious turbulence.
And we saw that turbulence in the stock price. The market reacted really strongly because the quarterly operating loss was substantial. We're talking $36.3 million.
And this isn't just about covering expenses. This is a capital-intensive research and development enterprise.
Right.
I mean, investors are placing their bets entirely on the execution of a massive future vision.
Right. Not on any current profitable metrics.
Exactly.
And when you're funding the construction of, highly complex nuclear infrastructure, the capital requirements are just astronomical. It forces investors to consider the immediate risk of dilution.
For sure. Now, they are sitting on significant liquidity. They have a strong balance sheet, roughly $1.2 billion in cash and marketable securities.
But they have signaled they're preparing for a long haul of capital raising.
Which brings up a crucial term for our listeners, the shelf registration. They recently filed one to potentially offer up to $3.5 billion in various securities.
So that could be stock, debt, warrants over time.
Right. And for anyone who's unfamiliar with that term, a shelf registration is essentially the company giving itself permission to issue shares or raise debt quickly down the line.
They aren't doing it today.
No, not today. But they are signaling that to fund these ambitious construction projects, they have reserved the right to significantly dilute existing shareholders by offering, that $3.5 billion worth of new securities.
And that potential for dilution, it just creates serious downward pressure on the stock, especially when you couple it with the technical volatility we've seen.
The stock has been highly sensitive, trading way below its recent highs. And we also have to talk about the optics of insider selling in a story like this.
That's a key piece of information you just can't ignore. We saw transactions recently where key executives, including the CEO and the CFO, were engaged in some significant selling.
Over a 3-month period, insiders offloaded, over 500,000 shares.
Yeah. Now, this is a nuanced point. When a company is this young and executives are suddenly liquid, it's often explained away.
Right. You'll say key personnel are finally gaining access to liquidity after the company went public via SPAC merger.
Yeah.
They need to diversify.
And that's fair. But when you combine it with a substantial earnings miss and the prospect of major future dilution, it naturally weighs on market sentiment.
It does. It raises the question. If the future is so assured, why are the architects taking money off the table now?
Right. The core message here is that the investment narrative is absolutely binary. You are accepting all these financial risks, the pre-revenue status, the losses, the dilution threat.
Because you believe entirely in the successful commercialization.
And that's where the bull case kicks in, and it provides that intellectual bridge from all this financial risk.
And it's not just big, it's massive. They are addressing an urgent need driven by two of the biggest industrial shifts of our time. Global electrification and, more immediately, the overwhelming power requirements of AI.
The demands coming from data center operators and hyperscalers, they're just rewriting the energy playbook. They need firm, consistent, high-density power that intermittent sources like solar or wind. They just can't guarantee it 24/7.
And that brings us directly to Oklo's core technology. They operate in the advanced nuclear sector, developing fast-fission microreactors, which they've branded as Aurora.
And what's critical for you to understand is the technological lineage here. This isn't just some theoretical lab work.
No, not at all. The Aurora uses a liquid metal sodium-cooled technology that is rooted in over 400 combined reactor years of operating experience.
That history traces back to proven designs, like the experimental breeder reactor 2. So what that means in practical terms is they are leveraging decades-old, established physics.
Right, but applying it to a modern, scalable microreactor design.
And the choice of that technology is absolutely crucial for de-risking the deployment. They are not using standard light water reactors.
No. These fast reactors, like the Aurora, they're designed to run hotter, more efficiently, and the sodium cooling system provides inherent safety features and allows them to utilize highly flexible fuel types, which we will definitely get to in a moment.
Their business model is equally compelling, and it speaks to why that capital requirement is so high. They follow a build, own, operate model.
Meaning they intend to construct the reactors, manage them, and then sell the power directly to customers, like those data center operators, under long-term contracts.
If they can pull that off, they transition from a risky tech developer into something more like a utility operator.
With highly predictable, recurring revenue streams backed by long-term power contracts, which you can then leverage to finance future deployments.
And the demand side of this whole equation is just staggering. The entire investment thesis relies on their ability to plug into that next generation of industrial power needs. Just look at their stated customer pipeline.
The pipeline is cited at a massive 14 gigawatts. To give you some context, 1 gigawatt can power about 750,000 homes. So 14 gigawatts is an immense, almost staggering amount of committed interest.
And it's predominantly made up of those data center and hyperscaler operators who are just scrambling to secure power for their next wave of AI infrastructure.
But that level of demand is only meaningful if you can deliver on the timeline. Historically, the Achilles heel of nuclear has always been bureaucratic drag and permitting delays.
Exactly. Which is why this next major point of analysis, government acceleration, is so profoundly important.
This is really where the story shifts from, future promise to imminent construction. The company was selected for 3 projects under the Department of Energy's new Reactor Pilot Program, or RPP.
And the RPP fundamentally changes the timeline for advanced nuclear in the U.S. It provides them with an accelerated authorization pathway.
So unlike the traditional process, where you must receive full operating approval from the NRC before you even put a shovel in the ground,
the RPP lets them move into significant physical construction activities in parallel with the ongoing regulatory review.
this parallel process is the game changer. Management wasn't exaggerating when they called this operating at Manhattan Project-level speeds.
It really condenses a multi-year regulatory bottleneck into something that runs concurrently with engineering and construction. This is a monumental paradigm shift.
And we are already seeing the physical manifestation of this speed. I mean, ground has been broken on the Aurora powerhouse at Idaho National Laboratory.
Right. Major excavation work is underway, moving them towards their goal of initial operation in that 2027 to 2028 timeframe.
And beyond just regulatory speed, they are also de-risking the supply chain for that crucial first plant. They signed a binding contract with Siemens Energy for the power conversion system.
That's the massive steam turbine and the industrial generator.
And securing that component, the SST 600 steam turbine and the SGen 100A generator, that's a huge win because it's a long lead item.
And critically, it's a commercially available, proven technology. They're not waiting for some bespoke, unproven power-generating component.
It just further shortens the timeline and reduces the engineering risk. And this momentum isn't just domestic.
No, they've also secured major international backing, notably through a strategic partnership with the European nuclear heavyweights, Nucleo and Black Halla.
Yeah, that partnership includes a plan for Nucleo to invest up to $2 billion into U.S. advanced fuel manufacturing infrastructure. That shows global confidence and helps solidify the domestic supply chain.
Which brings us to what I think is their deepest strategic moat, the fuel cycle. They are employing a vertical integration strategy that is truly unique.
Exactly. Their fuel strategy involves two major components beyond their core reactor design. First, the acquisition of Atomic Alchemy, which is focused on radioisotope production.
That could provide a separate, high-margin revenue stream.
Right. And second, the massive $1.68 billion investment plan for the Tennessee Advanced Fuel Center focused on recycling used nuclear fuel.
So why go to all this trouble and expense to vertically integrate the fuel cycle? Why not just buy HAU fuel from the market?
Because fuel supply chain risk is a critical choke point for advanced nuclear. By integrating, they gain flexibility. They aren't beholden to volatile enrichment markets for fresh HAU, that's high-assay, low-enriched uranium.
They can use fresh material, recycled material, or, and this is the real game changer, government feedstock.
And this is the intellectual centerpiece of the entire thesis, the plutonium bridge fuel.
It's an elegant policy solution and a technological triumph all rolled into one. The government is making up to 20 tons of surplus weapons-grade plutonium available.
And this material was designated as a costly liability. It was slated for a dilute and dispose program that was projected to cost taxpayers tens of billions of dollars.
So you're turning a massive policy and financial liability into a resource. That 20 tons of plutonium can be converted into roughly 180 metric tons of fuel for the Aurora reactor.
That is an enormous amount of energy locked up in material the government otherwise had to spend billions just to bury.
And this is where the physics of the fast reactor comes into play.
Because the Aurora is a fast reactor, that plutonium can be blended with unenriched uranium to create a metallic fuel form. And this blended metallic fuel bypasses the costly, complex, and time-consuming front end of the fuel cycle.
The enrichment process.
The enrichment process entirely.
So they eliminate one of the biggest bottlenecks in the traditional nuclear timeline and secure enough fuel to run their first 10 to 20 plants.
It is an unparalleled competitive advantage. It dramatically accelerates their ability to reach commercial deployment speed, using what was once a multi-billion-dollar waste problem.
This flexibility, the ability to use different feedstocks and recycle their own fuel, that's the foundation of their long-term cost advantage.
Exactly. They are mitigating supply risk while simultaneously leveraging a huge policy priority of the U.S. government.
And while the major powerhouses are aiming for that 2027-2028 timeline, let's not forget that potential near-term revenue generator you mentioned.
Right, the Atomic Alchemy pilot plant in Texas, focused on isotope production, that's on track to be operational by mid-2026.
And that's significant because isotope production is a high-margin business, and it provides a possible, though, smaller revenue stream much earlier than the large-scale power generation.
That could help to potentially offset some of those substantial operating losses we talked about at the beginning.
Okay, so we have accelerated regulatory pathways, secured components, a massive addressable pipeline, and a unique, secure fuel source. Looking ahead, what is the single most important factor for investors to watch?
It is the conversion rate of that 14-gigawatt pipeline. Excitement over a pipeline is one thing. Securing committed power contracts is another. Management is currently focused on creating what they call sophisticated offtake structures, rather than simply rushing into conventional power purchase agreements or PPAs.
Okay, let's clarify that. What is the material difference between an offtake structure and a standard PPA in this context?
Well, a conventional PPA is often standardized, shorter term, designed for established energy sources. For nuclear assets, which have lifespans measured in decades and require enormous upfront capital, you need custom-built agreements.
So an offtake structure is a deeper, more sophisticated commitment from the customer.
Exactly. It not only guarantees the long-term power purchase, but it also often includes clauses that help secure the project financing or de-risk the deployment capital itself.
So they are prioritizing quality and longevity of contracts over just announcing a high quantity of standard PPAs, which is essential for scaling.
Yes. This approach is critical for de-risking the enormous capital required to build out a commercial fleet from scratch. You need that predictable, bankable revenue commitment to unlock the billions in project financing necessary to move from one reactor to 10.
Absolutely. The success of the next 2 years really hinges on those complex negotiations that turn potential demand into ironclad, mutually beneficial power commitments.
When you step back and look at this entire story, the sheer speed of development mandated by the DOE's program, combined with using government surplus fuel as a bridge, it just fundamentally rewrites the expected timeline for advanced nuclear.
This company is successfully moving this technology out of the purely theoretical and into the physical construction phase, backed by a unique, integrated fuel strategy.
And the key question for you, the listener, remains that tension between the risk and reward. Does the accelerated timeline and that immense 14-gigawatt pipeline, paired with the unique fuel solution, justify the volatility and high execution risk inherent in a pre-revenue company?
I mean, the ability to turn a $20 billion taxpayer liability into the cornerstone of America's advanced nuclear future is a policy and technological maneuver that sets a new, incredibly high bar for the entire sector.
That's a powerful thought for everyone mulling over the future of energy investments.
Make sure you subscribe to the podcast so you don't miss our next analysis of the markets.